there is a lot of uncertainty in the markets right now. Now we have actually had what we would classify as a melt up scenario, but that's about to change and things are starting to look a little different today than they used to. And that is why we want to explore some changes and the risks that are associated with the economy and the stock market. Let's start with number one, economic and stock market risks. As we're diving in, we have seen a lot of change over the course of the last 6 months. And we started out in this environment with some good growth that has happened and a lead to scenario where we've had a growth of our economy with a little bit of inflation. But things are changing, changing pretty rapidly right now to where we're going now to what we call a risk-off regime or scenario. You see, we've been in this melt-up type of environment, especially with technology stocks. And Nvidia has been leading the way with that, but that's not the case anymore. We're starting to see breakdowns of whole industries and strategies. So whether it's small companies or even if you're talking about Europe and Asia, which we have really highlighted have been really good places to be, are starting to change. Now, one of the reasons is because we're starting to see just a change of growth starting to happen. And that leads to caution. So safe havens like bonds have been really a horrible place to be invested for almost the last 2 years. But we're starting to see changes starting to happen, and they may actually start to be that good place of what we call a safe haven. Well, the global economy has also been in this lead to scenario where we do have growth of the economy and growth of inflation, but we're shifting, especially in the US here, to be lead 3, where we have a slowing of growth, but sticky high inflation. Now, yes, there are some areas that inflation is coming down, but there's others that it's actually starting to pick up. So when you take a look at food prices, that's starting to pick up. Housing is sticky high. Rent is not far behind. So those are huge elements that come into what we call the CPI or the Consumer Price Index inflation. Well, then with all the different aspects of the wars that are happening, especially with Russia really starting to antagonize and go after Europe, and I can start to see all of the different things that are starting to happen on the global front, which is why things are really starting to get a little more rocky. So there's a lot of risk that's starting to be felt. Now that necessarily hasn't been felt in the stock market yet, but that's the reason why we can be making some changes just to keep up. Let's talk about those changes in number 2, portfolio changes. There are changing conditions with the stock market, and right now we are looking at many different elements of what we're going to be doing to making changes to the portfolios. Now, like I said earlier, bonds have not been a good place to be invested in. Every time we start to try to tiptoe back into them, they get tamped right back down. Well, this is no different. We've seen this starting to happen where we've seen the bonds starting to gain and then they really crash by, say, 5% almost immediately. But here's the thing. With all of these changes, especially within an environment where we are more likely than not to see a rate cut probably in September, that's because of the elements with how we're starting to see some, elements of unemployment starting to creep up. Well, that's what the Federal Reserve is looking at. And because of that, treasuries start to go up in price as that safe haven. So they may be a good part to add in right now as part of the portfolio where they haven't been for the past 2 years. But then we get other elements that we can start adding into as well. So bonds are one thing, but then we want to be reducing equities and commodities. So the stocks and commodities as well. Because if we're looking at some of the different elements of commodities, well, agriculture is still doing good. But when we start to take a look at the different things, like the metals and the base metals that have been working for the past, number of months and probably up to almost a year, again, things are changing. So we want to be reducing that aspect and putting more money to work in cash alternatives as well. So ones that are paying high dividends and interest. So that's really the areas that we're in right now. But energy also is one of those things that has been going down up until the last couple of days. Now, it's not saying that we need to be buying back energy yet, but keep it on your radar because that may be another element of sticky high inflation. So those are some of the things we're seeing. But then one of the elements that work in this environment, gold. And we've been talking about gold, and we've been having gold as part of the portfolio, and that is another one that we want to be keeping there. So yes, we're making changes. We'll be reducing the stocks, increasing bonds as we get through these summer doldrums. Number 3, wealth management and advanced planning. Navigating the world of taxes can be overwhelming, but there are many reasons why we actually want to be working to mitigate or reduce your taxes. Not necessarily avoid them, but work to make sure that we are paying the least amount that we need to be. So one of those elements comes to trusts. Well, we can have irrevocable trusts, but we can, with especially larger ones, they may need to be changed. And we can work with decanting trusts to allow for different irrevocable trusts to be established and to possibly lower taxes in the future. But that may not be where you're at. And so there's different opportunities that you have as well. Well, we can use your inherited IRAs and we can actually have them being distributed to trusts so that your legacy may be, well, safeguarded and others may be provided for many generations. Now that actually may be a great way to reduce what could be owed in the future from different estate tax and possibly some generational taxes as well. With you as a business owner though, that may be a good option to use what's called a qualified small business stock as a way to really actually get rid of and remove all capital gains if held correctly. So we can be using that as well. Now, all of you have the opportunity in different capacities to go into what we call opportunity zones. Now these are really good areas around the country that have been designated for revitalization. And what this can do by government law now is saying we can actually defer or even eliminate some of the capital gains on your investments. So by way of putting into these opportunity zones some appreciated assets, this may actually be able to use the money to grow in helping underprivileged areas and actually have no tax consequence possibly on the backside. So there are a lot of opportunities there. Also, non-qualified stock options. If you have these, there's a lot of flexibility in how you exercise them. And what we're seeing here is that there's many different strategies and many different ways. So I've highlighted a number of them in a very fast manner. But as we take a look at taxes, that's really the necessity to put together a strategy and strategically work with them to help reduce your overall tax consequences today, tomorrow, and in the future. Number 4, our second opinion service. As a reminder, if you or someone you care about wants a second opinion or what we call a stress test on your overall wealth plan, we're here to help. You see, whether we're talking about the differences of your portfolios or different aspects with respect to some of the tax savings that can be done within the structure of your plan. That's what we're here to do. Take a look at where you're at today, where you want to go in the future, and then see if there's any gaps that exist. And what we want to do is help put together a plan to try to either mitigate those or eliminate those gaps. So with that, please feel free to reach out. We would love to hear from you. Take care.